Growth in the ASEAN region has been remarkably stable over the last few years. When we talk about ASEAN, we talk about emerging ASEAN. Indonesia, Malaysia, the Philippines, Thailand and Vietnam. GDP growth in these countries has picked up recently. The disinflation process is very clear, albeit bumpy and volatile. Fiscal policy has remained intentional with a clear focus on boosting capital expenditures, and fiscal consolidation remains on track in most of these countries. At the same time, the central banks in this region, for the most part, are looking for opportunities to lower policy rates. The big question for 2025 is what happens when tariffs hit. Now, there are so many unknowns around the potential timing of tariffs, the targeted sectors that the tariffs could impact, the targeted countries that the tariff could impact. It's almost like a black box at this point, and the known unknowns as we go into next year are very high. The risk of tariffs essentially emerged from President-elect Donald Trump's policies in the US. He has time and time again reiterated that he is quite keen to impose tariffs on countries such as China, and even recently he named Mexico and Canada as targets for tariffs. Now the question is, will he directly name the ASEAN countries, or will the ASEAN countries just become collateral damage in the trade protectionism environment that we are in? Either which way, what we have done to try and decipher the situation a little bit better in our own books is we've created 3 scenarios under which we think tariffs are possible for this region, and they could be impactful as well. Under the first scenario, the increase in tariffs is limited to mainland China. We assume that the mainland Chinese economy is hit with a 60% tariff bill from the US. This essentially means that GDP growth in mainland China could be lower by 1 percentage point in our house view. And that would have a knock-on impact on the ASEAN economies. While if the tariff increase is limited to China alone, the modest negative impact on ASEAN growth would be felt as a one-time shock in the year of tariff implementation. Over the medium term, however, we do think that the economies in this region will continue to benefit from supply chain diversification, China plus one policies, friendshoring, offshoring policies, so to speak. The benefits of these sort of policies have been very clear in recent years, and you've seen FDI inflows into this region increase quite substantially, not just from mainland China, but also from the US and the EU. Now, under scenarios 2 and 3, we do expand the scope of tariffs from the US to all of the US's global trading partners, including the ASEAN 5 countries. Under scenario 2, we assume that there is a 10% tariff increase, and under scenario 3, we assume that there is a 20% tariff increase. Under these 2 circumstances, we do think that ASEAN growth will be impacted by a non-negligible 0.7 percentage points under scenario 2 and 1.4 percentage points under scenario 3. Let's go in order by the countries of impact. We think that the country that will be most impacted is Vietnam. About 30% of total exports from Vietnam go to the US. This share has increased substantially over the last 10 years, while at the same time, Vietnam has also been a crucial cog in the China plus one policies. FDIs out of China into Vietnam have increased, and at the same time, China does remain one of Vietnam's largest trading partners. The exposure of the Vietnamese economy to the US, however, is clearly larger than China at this point, at least in terms of trade. So if the US were to impose tariffs on Vietnam, we would see a clear impact to growth, and we could even see growth going back to COVID levels. In terms of the products that Vietnam exports to the US, it is mainly electrical appliances and machinery. At the same time, there is also a fair share of exports that are textiles and footwear. So overall, the impact would be fairly broad-based across these key sectors should tariffs be imposed on Vietnam. The next economy that we think is vulnerable is Thailand, and this is partly to do with its exposure to the US, but also the fact that as an economy, the fundamentals are fairly fragile, which suggests that any external shock could exacerbate those fundamentals and make growth even worse. Thailand does share a trade deficit with the US, which means that it is exposed to tariffs from the US, and we do think that there would be a fairly significant impact on growth should tariffs hit Thailand. The next economy in line in terms of our exposure list is Malaysia. Malaysia is a small open economy, but also interestingly enough, we've seen the share of exports to the US almost on par with mainland China for this year in Malaysia, which is around 13-14%. This suggests that while the Malaysian export base is diversifying out of China and into the US, it does remain vulnerable to higher tariffs from the US. Most of Malaysia's exports to the US are directed to the electrical and machinery sector, and so in terms of the sector, the impact could be fairly narrow based, but overall this will impact growth to a large extent. Finally, moving on to the more domestic oriented economies of Indonesia and the Philippines. We think the Philippines is slightly more exposed to Indonesia at this point because the US is one of the larger trading partners for the Philippines, and in terms of export share, the share of exports to the US is much larger than China. For Indonesia, the exact reverse is true. The share of exports to mainland China is much higher than the US, which mitigates some impact from tariffs. The Indian economy has experienced a cyclical slowdown. GDP growth slowed to 5.4% in the July to September 2024 quarter. And while we do expect that on a headline basis, GDP growth will improve in the coming quarters, we expect it to average about 6.2% for FY25, year ending March 2025, and remain at 6.2% for FY26, which is year ending March 2026. Now, the good news within the GDP breakdown is basically that services sector growth has remained fairly resilient, but most other indicators are quite mixed. Going forward, we do expect that government spending, which has already picked up in October, will remain strong for the rest of the year and support growth. But activity data will remain mixed. While export growth increased in October, import growth was fairly weak, especially excluding oil and gold. At the same time, we saw a very mixed trend when it came to passenger vehicle sales, car sales, two-wheeler sales, so on and so forth. While there is an argument to be made that maybe GDP growth has bottomed in the third quarter of 2024 and it will improve in the coming quarters, we still don't think it will hit the Reserve Bank of India's 6.6% forecast for FY25. The focus for the Reserve Bank of India has remained very clearly on inflationary pressures. Even at its 6th December meeting, RBI kept its policy rate unchanged at 6.5%, citing stubbornly high headline inflation driven by volatile vegetable and pulses prices. Going forward, we do expect that the disinflation process will become clearer for the RBI and headline inflation will move back within its 2 to 6% target range. This disinflation will be supported by a good sowing season for the Rabi crop, by good output for the Kharif crop, as well as fairly subdued core inflation as we go into the rest of the fiscal year. The rate cutting cycle for the Reserve Bank of India, however, will likely be quite shallow. We only expect a cumulative 50 basis points from the RBI in terms of its rate cuts next year. Essentially, the story of India, at least from a fundamental point of view, remains a strong one. We expect that growth will be supported by favorable demographics, a strong push to develop infrastructure, as well as continued focus on trying to deepen certain sectors, particularly such as semiconductors, across the country. As we go into 2025, however, there will be numerous challenges that the economy has to deal with, including cyclical headwinds, global uncertainties, and elevated food prices. We do expect that while policy will be nimble, there is a risk that monetary policy could still err on the side of tightness in 2025.